Good morning and welcome to this Monday, December 19th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're starting off, excuse me, starting off the last week before Christmas, the Christmas holiday. So we've got 5 more trading days to go. And this is the second half of the month. This is when everyone starts to look for that Santa Claus rally. We certainly showed very few signs of that last week, especially the last half of last week. We got the Fed announcement out on Wednesday, and there's a lot of selling that took place after the Wednesday 2 p.m. announcement. Little surprising, too, because there really wasn't any more, what I would say, bad information or bad data given out. I think the Fed is starting to turn a little bit more dovish, but apparently not enough for the market. We got the Tuesday, November CPI report out. And of course, we had a nice jump on Tuesday, but we are quite a bit off of that high that we saw from Tuesday morning. After that opening gap, we saw a lot of selling. And then, of course, the Fed announcement came out on Wednesday. So a little piling on there. We had options expiring. And as I mentioned at our Tuesday Max Pain webinar last week for our Earnings Beats members, there was definitely some potential downside heading into the option expiration Friday. So that may have been some, a bit of a drag as well. I don't know if you saw, the stock that we had on our list last week is the one that had the highest in the money call premium. In other words, a stock that had really run up a lot, so that there were a lot of in the money calls, a lot of people making money on calls. Got to be careful, because in the last few days, the market can really pull that carpet out from under you right before options expire. And that's what happened to Netflix, in my opinion. Stock was trading over $320, closed in the around 290 on Friday, and wiped out, I don't remember what the number was, couple hundred, 200, $300 million worth of net in the money call premium. It was poof by Friday. Got to be really careful, because Netflix had been a strong performer, really looked as good as just about any chart in the short term, certainly any of the big large cap names, and all of a sudden just completely lost all of that in the money call premium. So anyway, just another lesson there, that you do have to be careful. And sometimes, when I'm looking at a stock like Netflix, I don't think to myself, I want to short it. I mean, you certainly can if you want, and it would have paid dividends for sure this past week. But I just think, okay, now is not the time to buy it. If you're looking at it and you're heading into option expiration week, you think, wow, this has been a great performer, I'm going to jump into Netflix. Might want to think again when it's option expiration week and you've got so much in the money call premium. And that's really the lesson for me, is you've got to be careful. You got to take everything into account. I've listened to Dave Keller over at Stock Charts talk about being a pilot and just having awareness about everything that's going on around you. And, even before you take off, to know exactly what's going on, you need to know the weather conditions and all this. And he goes through in great detail and talks about being a pilot, and how preparing for the stock market is very similar to being a pilot. And when I think about Max Pain, that's kind of what I get drawn back into. It's like, you've got to be aware of these things. Anyhow, rant over. We're going to talk more about market in just a minute, but let me take you over to Earnings Beats for just a second. Couple things. Well, one thing in particular I want to point out, please mark your calendar, Saturday, January 7th. Click on this Register Now button and sign up for our Market Vision 2023 event, The Road Ahead, Navigating an Uncertain Market. I mean, I don't know if we could come up with a much better title for this event, because technically we really do have a fork in the road here. Is the market, has it run its course? Is the bear market, the cyclical bear market, over? Are we going to have a strong 2023? Or is this downside just beginning? Is this the start of a secular bear market? I mean, we've got some great folks to talk about it. Grayson Rose, Dave Keller, Julius DeKempenaar, all joining me from stock charts to give you their thoughts, how they're approaching this market, what they think, how they're positioning, what you should be looking for. Again, all that awareness. That's what we're going to be talking about on Saturday, January 7th. This is the 4th annual event where we've done these market vision events. I'll give you my take. I'm going to lay out 2023 for you the way I see it. I laid out 2022, pretty much nailed it until here at the end of the fourth quarter. I really thought if you had told me that, 2 months ago when the 10-year treasury yield was at 4.33 or whatever it was at the high, 4.33%. If you had told me that it was going to go down close to 100 basis points before year end, I would have said that fits perfectly into what I said last January, and growth stocks will roar into year end. Well, they haven't exactly roared into year end. They are outperforming. Growth stocks have been outperforming value stocks, but they are not exactly roaring into year end. So that's been a surprise. But other than that, I think this year that I laid out back at the beginning of the year was pretty strong, pretty close to what we've seen. Weakness the first half of the year. I thought we'd see a much stronger second half of the year, and we've seen kind of glimpses of that, but we haven't been able to sustain it. So we've been more choppy here in the second half. But anyway, I'll give you my outlook on what I see coming up in 2023 at this event as well. So just make sure you sign up. It's a free event, no credit card required. It's going to fill up. We will reach capacity, so you want to make sure that you've saved your spot. Click on that link, make sure you get yourself set up and registered. Also, and if you do register, we'll have you set up as an Earnings Beats Digest subscriber as well, which is a 3 times a week newsletter. This is one you can cancel at any time. You don't have to remain a member. There's no cost. There's no credit card for this either. Name and email address, which again, if you give it to us for Market Vision 2023, we'll get you set up for this. But this is a free event or free newsletter, and we try to make this really educational. Very simple, 2-paragraph, 1 chart kind of a deal. Literally, you can look at it and probably in 2 or 3 minutes, you'll be done. Very, very quick, something to think about. All right, speaking of something to think about, let's talk about what happened on Friday. So the Dow Jones Industrial Average finished on Friday down 281, S&P down 43, NASDAQ down 105. On a percentage basis, actually, the S&P was the biggest loser there. The NASDAQ actually outperformed the S&P a little bit. But, the breakdowns and some of the technical problems that were created last week are fairly obvious. One in particular, the NASDAQ breaking back down below its 50-day. It had already lost its 20-day. Now it's back down below its 50-day. If you check out that PPO, it has just turned negative again. So, one of the first things the bulls are going to have to do, I think it's pretty clear, is we need some strength to rectify that. The NASDAQ going into year end, this isn't a good look. And now that we're below the gap support, because that was kind of the final straw in the short term that I was looking for, that didn't hold either. We actually closed below that level. I think that was 11,850. We finished down 11,000, or excuse me, was it 10,850? We'll look at that in a minute, but clearly we closed down below the top of that gap support. So that brings the bottom of gap support now into play, which is another few hundred points on the NASDAQ. Then we've got the October low, which is only, 500 or 600 points away, maybe 5%. So heading into year end, we're not seeing that Santa Claus rally just yet. We need to get back through some key resistance levels. And I would start with the NASDAQ in that 50-day moving average. Mid caps down 1%, small caps down 0.9%. Looking at sectors, communication services, this was your best performing sector on Friday, and it lost 0.02%. So all 11 groups were down. Communication services was the best. Materials held in okay, down just 0.43%. But then we go to the weak groups. Real estate down almost 3%. This is normally, seasonally, one of the best sectors in December. It's now at its December low. So not exactly having a great month here in December. And that action on Friday took the real estate group back down very close to its 50-day moving average, and also right down to test that gap support level back from November 10th. So that's going to be a big level. We're pretty close to key support on real estate. It loves the month of December. This is when real estate needs to turn. Discretionary, not good at all. In fact, the three key areas, the three key sectors that I watch, communication services, you can see right here down below its 50-day moving average. Then you've got discretionary, not only below its 50-day and 20-day moving average, but getting close to that low from November. So it's getting very close to where it was just before that news came out with the October CPI. That was November 10th announcement. That's where the gaps came from, almost all the way back to the low before that. So not only have we given up the gains after that news, but we're back to a level before the news even came out, which is not good. That is not good action. Utilities losing ground. Utilities have been trending higher, but we did go back down and close below the 20-day moving average. Not a great look there. So normally we're sitting here in the second half of December, usually with some pretty good looks on the chart. Not really seeing it here right now after the weakness we saw last week, coming on the heels of a really good CPI report. The QQQ gapped up, was at 296 after that. And now I don't know where we are, 274. Have to look, take a look, 273, 274, something like that. Anyway, big drop, 6-7%. Again, maybe some of it is option related, although by my calculation, the QQQ went below max pain. So if anything, to start this week, I would expect to see us jump back up. But we will see. Currently, let's see, we have futures. Never did give you the futures. Dow futures unchanged, S&P up 2 points, NASDAQ up 20. Really not much there. Crude oil prices up $1, back over $75 a barrel. 10-year Treasury yield up 9 basis points today, 3.57%. With the way everything is transpiring right now, the last thing I want to see is that 10-year Treasury yield go back to 4.30. So that will be something to keep an eye on. 10-year Treasury yield's been down. That should be having more of an impact than it is, but so far, not really that much. 10-year Treasury yield, looking at the chart here, you can see right now we are at 3.57%. Again, up 8-9 basis points, but still below the 20. And if you look back to where our breakdowns occurred and gaps and so forth, like right here, we had a gap down and opened at 359. And since then, we hit 363 that day. The next day, intraday, 363. The next day, 361. A week later, 363. So kind of getting this feel like 361 to 363 is a pretty big deal in terms of yield resistance. Then you've got the 20-day right now at 360. So if you get back through 363 and close above that level, that in the short term would start to be a bad signal in terms of the yield going higher. And if the yield starts to go higher, any gains that we've seen in growth stocks versus value stocks could start to see some pressure again. So this would not be a good development for the stock market. Something I'll be watching, 10-year Treasury yield. All right, S&P 500. So there was the gap up. And you can kind of see what we, almost did. Like I said earlier, we've had some strength in the second half of the year. We just haven't been able to sustain it. It's just been too choppy. But right here, you can see 4,100, and then we could even go just a little bit higher. I'll drag that up just a bit. I mean, that's 4,110. This is 4,100, these two over here. That initial low that we had all the way back in February was 4,100. So we have had some history at this level. We got right up there after the November CPI came out, got right to 4,100, and then the selling kicked in. And we've lost 250 points on the S&P 500 since last Tuesday's opening bell. That's a big drop in a very short period of time. Now, there are some things that give me hope. I mean, I don't like to see that move back to the downside. It does look like we're rolling back over. I think you have to be cautious. We lost gap support. We lost the 20-day. We lost the 50-day, all on Friday's close. None of that was good. But when I talk about hope, One thing coming into 2022 that I thought was a big problem, more so in the options world with the equity only put call ratio, but volatility is the other sentiment piece that I look at. And if you look at the VIX, I mean, here we are with 4 straight days on the S&P 500 turning lower, and the VIX initially went up, but look at the last 3 days last week. It's almost like, I mean, the VIX jumped up right before, at the start of last week, right before the CPI announcement, the Fed meeting, and the policy statement that was due out on Wednesday, option expiration. It gapped up almost in anticipation of that. And you would think with the selling, the big selling we saw last week, that the VIX would have taken off. Think about what the VIX, this is the important part about the VIX. Think about what the VIX is. The VIX goes up when the market goes down because usually volatility is associated with selling. There's usually not a panic to get in when the market's going up, but there is usually a panic to get out when the market's going down. So when you start to go down, the VIX usually rises and options become much more expensive because a lot of those folks that are watching the market action, maybe losing money on the long side, all of a sudden start to think, oh, market's going down, I'm going to start jumping into put options. Well, market makers essentially make those put options more expensive by increasing the premiums that you have to pay. If you know anything about the calculation of the VIX, it's based on the premiums of these short-term options, S&P options. And I'm talking about options that expire mostly within like a month. So normally when the market goes down, and again, let's go back and look at that S&P 500, usually when you see these big down moves, like look back in April, big down move right here. What's that, 18 or the 21st to maybe the 25th, 26th right here. Let's go back to the VIX and see what happened there. I mean, look at the VIX. Do you see what's going on? When you're panicking and you're selling off and the market is panicked, the market makers will price in that panic into options. So the S&P takes a big drop, the VIX goes up. So let's look again at what happened last week. The VIX, 4 days in a row. I mean, that's a big drop. Very similar to what we saw. Look at June, big drop. This April drop. Back in January, big drop. Every one of these, if we go forward and we look at the VIX, there's your January rise. There's that rise I talked about in April. Look at the June. Look at the VIX spiking and taking off. Look at last week. After Tuesdays, when we started the selling, the VIX finished more than 2 points below where it was when the selling started. The pricing of options is coming down. If the market was going to keep going lower and the market wanted to benefit, the market makers wanted to benefit from that increased volatility, we should have seen the VIX back up to 28 or 30 last week. Why are we sitting at 22 on the VIX? That's a message that you don't hear anyone talking about. And yet, to me, that is a signal that we have to pay attention to. That is a signal that's telling me this market's not going to go lower. Or if it goes lower, it's not going to stay lower. If we were in a secular bear market and this was the next big shoe to drop, this VIX should be up at 30 right now, 28, 30 minimum. And we're not. I mean, if we look at the intraday 5-day chart, look at what the VIX did during that entire selling. Let's look at the S&P 500. I mean, since Wednesday, it's been almost in free fall mode. Losing 5% in 48 hours is kind of a big deal. And yet we look at the VIX and it's just one big, here we were when the big sell-off began. We're below it. So as the VIX was or as the S&P was dropping for 48 hours, almost with no rally at all, the VIX went down. I mean, you can read that however you want to, but for me, this is telling me the market is not expecting, market makers are not expecting this selling to last. Otherwise, they take advantage by increasing premiums on the options. They're not doing it. And for me, listen, there's nothing more important than price action. This is a secondary, the VIX is a secondary indicator, just like the put call ratio, just like the PPO, just like relative strength, just like seasonality. It's no different than any of those things. It's just a sentiment indicator that's just telling me that the action I'm seeing in the S&P 500 isn't quite right. So do with it what you want. But as I look at the price action, it's hard for me to get excited when I see double top. We come back down. We don't hold the low from down below. We break down. We've lost the 20-day. We've lost the 50-day. We've lost this gap support. I mean, we need to rally back and get back up above these levels. If we do, I'm short term, I'm right back on the bullish train. And intermediate to long term, I haven't changed. And you can sit there and, sit back and say, well, I don't understand, market, is in a downtrend. If you look at a weekly chart, I agree with you. Here's the S&P weekly. That's a downtrend. We're right back down below the 20-week moving average. We failed at the 50. This doesn't look good. I got nothing to sugarcoat that. I mean, the only thing that I would say to someone who says, hey, what about the weekly chart, is I would just counter and say, well, what about the monthly chart? I mean, this looks pretty good to me. This is a long-term uptrend, got up, the PPO rolled over, we went back to the 50-month SMA, and now we're starting to bounce off of it. Went right back to price support. I mean, the monthly chart looks awesome. So if you're saying, hey, get off the daily charts, Tom, let's go to the weekly charts, I would say, well, let's don't forget about the monthly charts. When you look back at a secular bear market, 2008, 2009, that last drop, look what happens to the monthly PPO. Falls off the table to the downside. It goes negative. One thing that has coincided with every secular bear market in the last 100 years is that if you're in a secular bear market, it has to last for a certain period of time in order for the PPO to go negative on a monthly basis. And we'll go back 25 years. Let me show you what happened back in 1999 when the 2000 bear market kicked in. And well, there's 2008. 2008, there's your drop. There was that big drop below the center line. 2001, 2000 to 2001, we were moving down. Looked like, hey, we're bouncing off the 50. And then we went down to a new low. And when we did, PPO goes negative. So in my mind, I mean, here we bounce off the 50 and then we go down. It all looks very similar, except we haven't gone back down. We haven't set that new low. That next low would be a really important one, especially if that monthly PPO goes negative. That would be more of what we would expect to see in a secular bear market. In a cyclical bear market, I mean, here was 2020. So that was the pandemic. Real quickly, we went down just below the 50-day or 50-month and then rallied right back. Look at the trade war, fourth quarter. There was that cyclical bear market, bounced right back off of it. This was 2015, 2016. It wasn't a bear market technically because we never dropped 20%, but we struggled for about a year. And you can see went all the way back down to about a year and a half low, right almost to the 50-month moving average before we bounced off of it. Same thing in 2011. And if we go back, much further, let's just take this thing all the way back. I mean, when you go into these cyclical bear markets, let's see, what else do we have? How about, 1998 was very quick, didn't even really get down much below the 20-month moving average. But right here, 1990, that was the Persian Gulf War. That was a bear market. Where do we stop selling? 50-month moving average. We bounced. How about 1987, cyclical bear market? Where did we go to? 50-month moving average before we bounced. 81, 82, we went slightly below. And actually the PPO went slightly below before we turned around. That was right at the end of the bear market. When I talk about secular bear, secular bull, I call this the beginning of the secular bull because it took out the prior highs. And that usually is the start of a bull market. So even though we went down for a year and a half, didn't look very good. That technically, in my mind, was the start of the secular bull market. All right, this was all secular bear. So this move down was all part of the secular bear in the 1970s. Look at the PPO, very, very weak on a monthly basis. Now, when you go back here in 66, that was a bear market. I think there were 2 or 3 recessions, maybe 4 recessions in the 1960s. We had bear markets, but what did we do? We basically went down to the 50-month moving average, did it multiple times in the 50s and 60s. PPO got down right about to the center line, and then we went higher. So to call this a secular bear market right now, you're premature. You're hoping, you're wishing, you're expecting, you're anticipating, but you don't have one. This is not a secular bear market yet. This is no different than every other cyclical bear market that we've had in history at this point. Now, another move down, another swift move down, and yes, you got something to talk about. The bears will definitely be in charge. If I see that PPO go negative and we're back down at new lows and we're trending lower below the 50-month, that's going to start looking a lot like the 2000s, and it's going to start looking a lot like the 1970s. I just don't believe it's going to happen. I think when you get into markets like this, and yes, the news has been bad. Listen, January 8th, earlier this year, I talked about this before it happened. You got to keep the market in perspective. At the beginning of the year, we had gone up so much, and we had big sentiment issues. You had to keep your bullish perspective. You had to rein it in. I think now you have to rein in your bearish perspective. I said sentiment needed to change. My gosh, has it changed? We've gone from the Reddit folks thinking the market was an ATM machine to now everybody you talk to thinks the market has no chance of going higher. That's what has transpired in less than 1 year. Sentiment's reset. We got no problems there. Now you got to keep your bearish perspective reined in, because we don't know whether or not this is going to morph into a secular bear market. I don't see it personally. I just don't see it. Not with interest rates sitting at 3.4%. I mean, like I said, if rates start to take off again, and then we break down, we got these monthly PPOs turning negative, then it's starting to look like a secular bear market. Right now, it's too early. NASDAQ 100, just looking at the daily chart real quick. There was your gap support. There was your breakdown. Again, does it look good? No, it does not. It looks to me like we could go down to gap support. It looks like we could go back down, test that mid-October low. That would be another 700 points. So roughly 6 or 7%-ish, maybe just a little under 7% to the downside. But when the market sells off, that can go, that can happen pretty quickly. But I'm telling you, if you look back at history, when the VIX starts to unwind, that tends to be market lows. And it's been unwinding. Wrote an article over the weekend. I don't know if you had a chance to see it, about small caps. Small caps, when you look at the small caps relative to the S&P 500, we had this really nasty run from 2018 through the beginning of 2020. Then the pandemic actually saw money rotating heavily into small caps before going back down again. But now it's starting to turn back up, and it looks like we have an uptrend here. And then when I look at the mid caps, I'm looking at kind of the same thing. And then I'm looking at the NASDAQ. This is where perspective really helps. If you're just looking at the market going down and you're reading media and the news, listening to the news, you're going to be brainwashed. You're not going to have any hope of keeping any perspective. When you're just looking at the charts, we're in an uptrend that we have been in now for 1.5 decades. The NASDAQ outperforming the S&P 500. Now, it's been a very, very rough year, but since the pandemic began, I mean, 2020 was an unbelievable year for those large cap names like Apple and Amazon and Tesla and all those names. They went up so much. And now everybody's scared because they've come down so much. But basically, they've just kind of gotten back in line with the historical norm. I mean, to start the year, honestly, this is what we needed. We need people to realize that these are not, that the market is not an ATM machine. It's not easy, especially when you get into a bear market. Anyhow, I think things are moving back down, kind of normalizing a little bit after that crazy run in 2020. And during 2020, when it was going up, listen, I was not one who was saying, hey, we're going to pay the price down the road. I mean, I was right in there with everybody, bullish as could be on the way up. But what I do going into these market vision events is I just I try to step back, look at charts from all different time frames, all different areas of the market, look at all my ratios, look at sentiment, look at history, and try to make an objective assessment of what I think is going to happen in the next year. Trying to put everything together. And that's not easy to do in the moment when you're watching the market go down and everyone's talking about recession and rates are going to go back up and inflation's still a problem. And oh my gosh, Apple's horrible, Tesla, my gosh, they're, Musk is all, he's too involved with Twitter. And so Tesla's fallen like a rock, and it's easy to get caught up in all that. Try to have a little bit of perspective when you look at the market. Reflect on where we've been, reflect on where we might go, reflect on history, how these bear markets play out. I've studied these a lot. I'm not just randomly saying, oh, I think the market's going to go higher. I've studied these a lot. Secular bear markets don't happen very often. We're not that far removed from the last one. Secular bear markets just don't keep popping up every 5 or 10 years. They're generational type markets. So I really think you just have to keep all that in perspective. All right, let's just wrap up with 3 stocks. I'm going to wrap up with the 3 I just talked about, the 3 big ones. Apple. Let's look at Apple, Amazon, and Tesla. How about those 3? All right, so Apple right now at a key support. If we fail to hold that October low, and we're right there right now, there's nothing until we get down to the June low, 129. Apple has been a bad performer. I mean, last week was very rough. Stock going down, big volume. I mean, if you're a long-term investor, I see no reason why I wouldn't be buying Apple at the current price. And if it gets down to 129, that's where I'd fill out my position. If it breaks 129 and you're worried, you can always get out and get back in. But this is an area where we could see a major bottom develop in a stock like Apple. Amazon. Amazon, I don't think is as healthy as Apple. And here we are in the Christmas season. You would think maybe there would be a little run up in Amazon. There's been no run up. Stock's been going down. It's got support down around 86. This is another one of those where when you look at the short term, you're like, wow, this is such a horrible stock. And then you pull out the 15-year monthly chart. And you say, well, you know what? Stock was $2 back in 2009, ran up to 190. Being back at 87, yeah, it's been rough, but it's not really that big a deal when you think about the long term. You look at this breakout, and it looks like to me we're down just a little bit below where the breakout occurred. I mean, the monthly breakout was right about there, April 2020, right after the pandemic hit. And we've gone down and given all that back now, and then some. Where's the next level? I mean, I could see that. I could see maybe this low right here serving as a low. So Amazon's got some room to the downside. I mean, I'm going to say worst case, and this would be, I think the market would have to really be in bad shape. But I'm going to say worst case 50. I think it's possible Amazon gets down to 75. I don't know. Monthly chart certainly looks worse than the daily or the weekly. And then the final one, Tesla. Tesla I'm looking at it. Had gapped up this morning already. It's given all that back. I was looking, I thought maybe 147 might be in the next level after losing 167 or 165, whatever it was. I think if I go back 2 years, I can point it out. No, need to go back 3. So it's been a long time since we've seen Tesla at this level. Do you see this triangle? I'll annotate this because I'm wondering if it's going to go back and just test the triangle breakout that it never tested in the past. If you look at this triangle breakout right here, usually when you break these patterns, you go back and you retest. Normally it's not 2.5 years later though, or a little over 2 years later. But right there, let's go ahead. This breakout took us out of this channel. So let's just go back and I'll show you what that breakout was. So right here, we were at 136. We gapped up the next day to 153, and we came down and closed at 147.20. So, and that's where we had a lot of volume come into the stock at the end of 2020. That, to me, is a pretty significant not short term anymore, going back 2 years. But that would be a level that I certainly would watch. The bottom of that gap support, like I said, was 136. So 147 would be a key level to watch. If it doesn't hold there, I'd be looking at 136. I mean, I can sit here and just point out every low going back since it was down $25. I would be looking for something to reverse here. Now, we have the daily chart, which shows positive divergence. So if I get a reversing candle on the daily chart, a big reversal, like an intraday move down to 147 or even below, come back up and close at 150, and you see a massive volume day with a positive divergence, that would suggest to me that the selling, at least in the near term, is over. So if you're trading, I'd be looking for something like that. I think jumping in right now is kind of like jumping on the tracks with a train coming. I don't usually like to do that, but that's up to each individual what they think. I mean, I think Tesla is a great buy long term, just like I think Apple is a great buy long term, and Amazon. Even though I don't like to chart quite as much on Amazon right now in the short term, Amazon's a great company. These stocks are being sold off. History tells us buy great stocks when they're selling off, but that's up to you. It's up to each individual what kind of risk they're willing to take. And obviously, if you think the market's going to keep going lower, then you're probably going to get these stocks a lot cheaper if you're right. I just don't know how much lower the market goes. We'll see. Anyway, that's all I got. Let's take a quick look at the market. And please, by the way, sign up. Go over to earningsbeats.com. Sign up for Market Vision 2023. It's free. We do this. We make it free for a reason. Try to help out as many folks as we can. I'm not trying to say I'm right. I'm going to be right, but I'll give you something to think about. I'll give you perspective. And I'm sure Dave Keller, Grayson Rose, and Julius DeKempenaar, when they join me, they'll tell you that they'll go over a lot of the same things, but give you their perspective on things. I have a lot of respect for all three. I think it'll be a great event. So make sure you get set up for that. All right. Looking at the market. Well, now we got the NASDAQ actually leading to the downside. In the futures, NASDAQ was doing a little bit better. So we got the NASDAQ leading a bit to the downside. Dow flat, S&P down just a little bit here. But it doesn't look good starting. So we'll see whether or not we get some buyers coming in. This is the most bullish period within the fourth quarter and within December. These next 2 weeks, right into year end. Don't misquote me. I'm not saying it goes up every year. Does not. But the odds favor the market going up into year end significantly. We'll see what happens. Listen, everybody have a great day. And I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. You just tune in over there at 9 o'clock Eastern. Just click on that link and you'll be able to listen to the show. I'll be back here at Earnings Beats for your next show on Wednesday. Have a great week, everybody. Good luck. Happy trading.